Welcome to Investors Insights, where today's topic is Recession Watch. This is setting up to be the busiest week of the summer as more than 150 S&P 500 companies are set to report earnings, and the Federal Reserve is expected to announce its latest policy move on Wednesday, which will definitely be a market-moving event. We'll also get an update on GDP, consumer confidence, inflation, and manufacturing activity. So really busy week. And before I give a detailed look at the current economy and leading economic indicators, Trey, give us an update on the Fed and also some housing weakness that we're seeing.
Yeah, absolutely, Bobby. And I think the Fed's going to be looking at a lot of the data that you'll be showing, and that's what's driving their decision. Many market participants expect the Fed to raise rates 25 basis points again. That's going to take the Fed funds rate from 5.25 up to 5.5. This is widely anticipated and likely mostly priced in. But it's what the Federal Reserve Chairman says after that decision that is so important, because it's about their indicators that they're looking at. Many people feel like inflation's coming down, so why does the Fed have to continue to raise interest rates? And it's because the Fed traditionally hikes rates until something breaks. Federal Reserve wants prices of everything to come down. That's their push on inflation. That's price of stocks, bonds, cars, houses. And they're not necessarily seeing that. So that's why the Fed typically raises rates until something really kind of cracks or breaks. And the economy seems to be continuing to muddle along, and so therefore really hasn't broken. You can see the largest direct impact the Fed has is typically on leverage-driven parts of the economy, and that's housing. You can see on this chart that the estimated monthly mortgage payment hit a recent high. It had dipped down as interest rates maybe started to fall and some housing prices started to roll over. But since then, housing prices have spiked back up and interest rates have spiked back up to highs, causing the monthly mortgage payment to, you can see over the chart, to just be at extremely high levels compared to any kind of recent history. And this is largely due to higher interest rates, but also supply and demand. This next chart shows existing homes available for sale. It's at a new all-time seasonal low. There is almost no inventory available. So that's keeping housing prices high, which is a very large input into core inflation, which is what's really challenging the Fed. The spread between core inflation and headline inflation, what we went over last week, is very, very wide. We've seen headline inflation come down, but that core is remaining sticky. And so that causes the Fed to want to continue to hike rates to try and break the back of this housing market or break some part of the economy they have direct influence. And we're not seeing that yet. So the Fed's likely going to continue to hike until we see that break, which is somewhat concerning for market participants because you never know until in hindsight it's happened.
Yeah, and so let's take a detailed look at the current economy to see what economic leading indicators are saying and what the Fed is looking at this week to decide their decision. So we continue to get a lot of questions from clients wondering if some economists are on track with their call for a recession. And I want to share this heat map that we continuously look at on a weekly basis that shows 10 leading economic indicators. And looking at this chart, the blue boxes show where each indicator historically has been near recession starts, and the gray boxes show where the current indicator is. So the first two, payrolls and unemployment rate, are strong indicators that say we're not close to a recession based on history. The third one, industrial production, is one indicator that is showing weakness. And taking a look at what indicators are showing weakness, it's industrial production, capacity utilization, which is a measure of output, and then the bottom two indicators on the chart here, which are connected to manufacturing. The two that we're focused on are circled in the chart there: retail auto sales and housing starts, which are well above where they have been in previous recessions. So obviously it's important to note that recessions are a contagion. And with 5 of the primary indicators still well above recessionary levels, we are still inclined to say the economy is still growing strongly here. And so we would need to see a majority of these indicators showing weakness to say that a recession is likely. And we're just not seeing that now. So that's a good sign. But obviously the question this week will be what says Fed about the future rate hikes, which could cause some of these indicators to turn lower if they are more aggressive. So all eyes are on the Fed Wednesday. A lot of economic news coming out, a lot of earnings, so really busy week. If you've got questions on anything we've discussed, please let us know. We love to engage with everyone, and hope everyone has a great week. Thanks.